about the same. Flip it on here. Okay, so I was talking with Kim. She's a CEO of the MoneyShow, and just realized I have been speaking at these shows for 20 years this year, and it's crazy. I've seen a lot over the last 23 years of trading. A lot of markets come in and out of favor. When I came into trading, I started off really focused on technical analysis, which was really strange back then, as you guys know, right? Over 20 years, some of you. So focus was mostly on fundamental analysis, really. Not a lot of technical analysis. You had things like point and figure charting, a lot of that, but not a lot of the advanced stuff that we see today. And I didn't have the advantage of having a mentor or a teacher to kind of show me the wings of how to read technical analysis. I was an artist before I got into trading and worked as an archaeologist of all things. So really digging through charts is a lot like archaeology in some respects to me. So I've always enjoyed it. It's been a fun hobby that I also get to have as my job. But back at the beginning, you know, things like core bull flags, bear flags, things like that. You hear these strategies, head and shoulders. But what was hard for me to figure out to begin with is that why is it that something looks exactly the same on this time frame as it does this other chart over here? Why is one of them working, but one of them's not working? You know, why does one of them go and give me 10 times my risk, and the other one stops me out? They look the same on a single time frame, so what's different? So what I did was I started digging into the patterns, looking at what are the individual components that go into the development of a trade. It's not just a snapshot of a picture. You're essentially looking at the different brush strokes that are making up the picture. A lot of times I'll use the image of a person's head, and when you are doing like still life drawings, you'll have your lines where you've got your eye placement and your mouth placement, but you have all kinds of different angles where things change and things shift. That's what strategies are like in the market. You have the core textbook strategy, but then you also got all these different variations that play out. So we're going to look at focusing on pure price development in the market. I'm not going to use any indicators here. We're just going to look at price development and how to read trend exhaustion when we're looking at price development. So let's head on over here to our charts. So 3 signs of trend exhaustion. We're going to start with measured impulse waves. Now this is going to be a really simple one for a lot of you guys out there. It's one of the core concepts in technical analysis. When you are looking at moves in the market and you want to know what an impulse wave is, you're basically looking for a visual representation of where you've got average to stronger than average momentum, basically a surge of movement that takes place in the market. This is what we call an impulse wave. We're going to talk about things like momentum as well and wave count here as we go a little bit forward. I did this class in Orlando last year, or earlier this year actually it was, and I'm like, when did I speak? And everybody was like, wow, that is just, I can't follow you. So I redid the class, a little bit of a lighter level here. We're going to cover a little bit more of the basic stuff. I know we've got a lot of you over there on the live streaming as well. But basically, one of the ideas in technical analysis that works really well for having an idea of when a trend is exhausted or when a trend is extended is to look at these major moves that are happening, just these larger swings that are occurring in the market. So these are what your impulse moves are. And when you're making a comparison, if you have a move that has a similar price and momentum move as a previous move, there's a good chance when it makes that same level that you're going to run into an exhaustion. Does that exhaustion mean that you're going to get a reversal? No, not necessarily. It can correct many different ways. A trend that is exhausted can correct through time. You can get choppier range. You can even correct by still moving higher, but just moving higher at a much slower speed. Or you can get what we think of as the technical pullback type of correction. So when you're looking at the impulse waves, you're looking at these stronger portions of a trend that have happened in the past. So if you're looking at a 5-minute chart, look back over time in that chart, 5-minute history, and look for these big surges in momentum. If you notice that you're wanting to buy something, but it's already at the upper end of where those surges have already happened, maybe you've got a 30-point surge and as an average of an impulse move. And currently, you've got a 20-point move already. You're not going to want to buy a move at a point like that because you're going to be dealing more with an exhaustion type of move when it gets to that level. So this is one of the main things that I'll watch when I'm trying to determine, is this going to be something that I have an ideal entry position of, or is it going to be something, hey, the trend might still continue in that direction, but I'm not going to get as much out of it as I would have otherwise. So this is just a really core concept here, these impulse waves. And you'll notice that impulse waves are fractal in nature. What that means, of course, is that you will have smaller impulse waves inside of a larger one. So the larger one here, you'll notice has 3 swings in it. 1, 2, 3. The second swing is the same momentum as A, B, C, and D. And so when it makes that same level, we see a pause. We see that trend stall or slow. A lot of times the trend channel that it's in will break at that point. Again, it doesn't necessarily mean it's going to totally turn around, but you will see a stall in that trend. So actually, I'm going to skip this slide there. We're going to go on to this one. We're looking at measured impulse waves. So when you have the same momentum taking place on a current move as compared to the previous move, if you just measure from high to low, you can use something like Fibonacci extension tool if you want to get fancy, or you can just visualize it like I do most of the time. You want to look for that same level. So if you're trying to short right here on a breakdown, after this zone to congestion, this is a typical breakdown zone that a lot of traders, especially newer traders, are told to use as an entry trigger. How many of you would use that as an entry trigger still? I know we've got a lot of veterans out there. Anybody? You gonna trade that breakdown there and that trade line? Wow, we got smart folks in here. Most people won't if you've been trading for a while, because by the time you look at how much room you've got before it's going to stall, you might not have a lot going on there, and you've got to keep your risk in check. That means a stop zone generally above here. So if I'm taking a trading range breakdown, I'm not often using a break of that entire channel. I'm trying to get in and build a position as it's in the channel. So these measured moves, they give you an idea of where these trends can come to an end, and they can help you judge too, is this a good point to get into it? Or am I better off waiting for a correction? If this is happening on like a daily time frame, then hey, you've got, a few days still that can go and keep going. So you might be looking down on a smaller time frame for an entry. So when you take a closer look at these measured impulse waves, you'll notice that as a bigger trend starts, you'll have the smaller impulse waves, and then you'll have the larger ones, like the turnaround back in here. And we're going to look at details that led up to the turnaround back at the end of last year. But we're also going to look at it on intraday time frame using some of the action this week. So here you'll see again those smaller impulse waves, but they're also part of the larger ones as well. But it can give you a guide on a current move. So a lot of people will say, hey, going into this week, the market was really extended on the downside. We're definitely due for a big rally. Yeah, we went up a little bit today, but does that mean it's totally done? Have we seen the end of this pullback, the end of this correction? How many of you think no? How many think yes? Right there, yeah, there's not a lot of volume either. Okay, well, I don't think anybody here has said yes. Nobody wants to go against the, no? Okay. Well, here are different possibilities looking at impulse waves on a larger time frame, looking at a bigger scale. So I'm going to be looking at not only the small moves, which is basically your purple one in here. You'll see kind of the counter trend bends. And this is what brought us into Monday's close. So we actually did see a reaction there at that smaller measured impulse wave, but we also have room on the larger scale. Now you'll notice a lot of these will have these corrections here in the middle, like the green one. It comes down, has the smaller impulse wave, corrects a little bit, and then continues. So this entire move here is one bigger impulse wave that consists of some smaller impulse waves. Same thing here with the yellow one, all the way from last year's highs, way down to our lows, New Year's Eve. And so if we look at that over here, if it paused or so right in here, we still have room that it could come all the way back down to there. We're in this big megaphone formation on the weekly and the monthly time frames in the market. And we've already seen, let's see, one, two, three, four, five. We're coming off of the 5th point on the megaphone. So this is usually a point where things start to get choppier. You don't see really easy continuation with the trend at this point. So it makes a lot of sense that we're going to continue to see corrective action here on the larger time frames. Another thing that we look for when we are looking at 3 signs of trend exhaustion is the wave count. So does this mean Elliott wave? Again, I didn't know what type of crowd I'm speaking to here. So it kind of, trend development can be really tricky to learn, but if you know the basics, it's going to give you a starting point. Remember how I was talking about how when you're doing your portraits, you've got your key reference points, but your head can be turned different ways. It's still a head. But that's a lot of how wave count and trend development can play out too. When I first started trading, I didn't know about Elliott wave. I started recognizing the same things that they teach in Elliott wave, but I didn't know what it was called or anything like that. So the way I look at trends is a little bit different than pure Elliott wave theory, but I'm going to start with the basics because that's what a lot of people know here is Elliott wave. And your 5-wave count, usually I count these as 3 waves, 1, 2, 3, because I'm counting the impulse waves. And then you've got the secondary corrective moves. And usually these are 2-wave corrections. Can't see it very well here on our euro dollar, but you usually get a 2-wave correction in here. What's really interesting about this particular one on the euro dollar, I'm going to mention this here. It's a little off on the side, but when you've got a time development correction following your first impulse move in a trend, and then you've got a price development correction where it's more of a bounce and a retracement in price, the continuation has lower probability that you're going to see that pure measured impulse move again. The reason is that we've got shifting momentum starting to come into play. So if this was opposite, if this was more of a price correction here and a time correction here, then you have a higher probability you're going to get a really solid, strong impulse move as the continuation. But coming off of 4 here, this could have gone to a slightly lower low based. It could have gone into more of a longer trading range. It's just not as high of probability of giving the solid continuation. So typical Elliott wave then says ABC correction, and this actually ended up breaking lower. But it's not always this clean. It's not always this pretty. So let's take a look at Netflix. How many of you guys see that 5-wave count here on Netflix? Anybody? Yes, we got one. Anybody else? Couple. You're thinking about it. All right, let's look at this here. So we've got a first swing down. This is a congestion over here. I should clarify that. So we're actually starting the trend here. So we've got a 2-wave swing down. There's a little bit of a slower start of it over here. And then we go into that first 2-wave correction. So this is ABC on Elliott wave, ABC. And then we get the next continuation. 2-wave move. So I like to count a lot more in waves of 2 than waves of 3. Elliott wave is big on the 3 waves, 3 impulse waves or 5-wave count. But what I've noticed is that you're more prone to see 2 main impulse moves. And then if it goes for a 3rd move, that 3rd move might be a strong impulse move or it might be a shifted trend. It's not always going to be as strong as those first 2. So I always focus first on 2 waves. There's more advanced stuff into determining whether you're going to get 2 or 3 waves. But that's my basic starting point, is to focus on the 2-wave count. If this was a stronger bounce here on the second bounce, let's say you got a higher high, then you're going to usually get more of a base again before it will continue, and then go for another 2-wave count. So here you've got your first swing down, first swing across, and then second swing down. And then here is our second correction. So if you're thinking in terms of waves of 2, look at the corrections between previous moves. You'll notice there a lot of times they're really close to the same. So from 1 to 2 over here, you got about the same amount of time correction as 1 to 2 to here. So that helps you recognize that, yes, this is a little 2-wave bounce here, but this is really the main correction right here between the 2. So this gives you a larger 2-wave move. And as I mentioned earlier, when you get more of a base and then more of a time correction, this can be less predictable for giving you a solid continuation move. But we do get that pretty decent continuation here with the 2-wave movement. And that brings us to the end of that 5-wave count here. So you've got 1 to the downside, A, B, C, 2, A, B, C, and 3, and then the longer correction. So even when things look really messy, if you're paying attention to 2-wave count, a lot of times that can help save you. So if you're trying to count all of these 1, 2, 3, 4, 5, and you don't know because there's so many highs and lows that are in there, if you try to focus on just waves 1 and waves 2, you're going to be pretty well off. You're going to be ahead of a lot of other people out there. So each of these smaller waves, they're more likely to have 2 main impulse waves than 3. This is what I mentioned earlier. So a lot of Elliott wave will teach you, hey, there's going to be 3 waves in each of these main impulse moves. I found that's not generally the case a lot of times. A lot of times it's just 2 main impulse moves. If it tries to go for a third, it's usually more stunted. So there's exceptions. So one exception, since you guys are a little bit more advanced overall here, is if you're looking at a V, we'll do YMCA. If you're looking at a V formation here, and you're coming back up on this side, so here's our downtrend over here, you're coming back up on the other side over here. If you're coming about a third of the way back up, and then you see a zone of congestion, you're more likely to get 3 waves back up. If, on the other hand, it comes up about a quarter of the way, a little bit of congestion, comes up about half the way, a little bit of longer congestion, then you're more likely to see that just have the 2 main waves, and those 2 main waves have 2 smaller waves up, little 2-wave correction, 2 smaller waves up. That'll bring it back to the upper side. So that's one way that you can differentiate between, you might be more likely to get a 2-wave continuation or 2-wave reversal versus a 3-wave reversal. Just a really simple type of move. So let's go on here. The third sign of trend exhaustion is, of course, momentum, a momentum shift in particular. So people didn't really talk about momentum when I started trading. You didn't read about it anywhere. You didn't really think about it. And it's one of those things that, like, once you see it, once you think about, how can you miss it? How can you not pay attention to it? I used to call it pace back in the day because you're just looking at the momentum or the pace of the buying or selling compared to the past. And it can be one of those tricky things to focus on because momentum or pace is just the rate that prices change over time as compared to how they happened in the past. A lot of people try to get fancy and say, oh, so do you mean like a 45-degree angle or something like that? That doesn't work. You can't put angles on your charts here like that because if you change your scaling of your chart, change your time frame of your chart, your angles are going to look completely different. So what you want to do is you want to look for periods in whatever security you're trading, and I trade a lot of different markets, so everything I'm showing you guys today just applies to any market you trade. I don't care if you trade options, if you trade Forex, futures, grains, I'll trade it on wheat, it doesn't matter. But momentum, if you look for zones where you've got basically these V patterns in the market, that's a pretty good starting point for what an average momentum move is. So each side of F and G here, pretty average, typical momentum. If you've got something that is stronger than average, you're more likely to get a slower than average correction. This correction right here, marked B, actually, if you go and pull up the NASDAQ chart from this afternoon, we had that exact same pattern. It had the strong impulse wave into around midday. I don't remember the exact time. I'm all over with time zones. And it had that main impulse wave, and it was a larger impulse wave on some of the larger time frames. So my traders are like, hey, let's look for reversal strategies. I'm like, whoa, let's not. Look at the momentum on this. This is a strong impulse wave. If you're looking on a tick chart, the momentum might not look as strong. But if you go and compare it to a time frame chart, it might be straight up. So a lot of folks get tunnel vision. They're focusing on the smaller time frame charts. They're focusing on tick charts. One of them might have a momentum move that looks like it's probably stronger than average, but it's not really when you go and look at the bigger picture. So the same action here this morning, we saw go to a slightly higher high, pulled back up, shifted again. These momentum shifts where you get the slower movement, they're more likely to lead to a stronger continuation. Now, since we were at the upper end of a larger impulse move in the market this morning, what happened is that impulse move was great for a short period of time, but it couldn't sustain it as easily. It needed to come into another correction again. If you literally go and take this chart here and look at it, you can pull this up on your charts right now, you'll see that this is the same repetition that we saw in today's action. And that's what I really love about the markets is that once you know and have a good feeling for technical analysis, you're reading human emotions on a chart. It doesn't change over time. You can even look at the housing market and apply technical analysis to the housing market. It doesn't matter what you are looking at because as long as it's a representation of human emotions in a market, technical analysis is going to work. And it's going to work really well. I know a lot of you guys, especially watching, you'll want a copy of the PowerPoint. I had some people come up before I got started. They're like, I can't stay the whole thing, but I want to see it. You can grab a copy of it. Go to tonihansen.com/Vegas, and I have it set up so it will email it to you. So just go there, enter your email address, and they'll shoot you over the PowerPoint. So momentum, shifting momentum here. We actually had a breakdown, so nice trading range here. One of the clues that a trading range is going to break in a certain direction is it will have the slower counter trend move within that channel. So here, really core technical version of it. You've got an average move down on H. It has some stronger impulse move action down here to begin with. It goes into a zone of congestion. This was Friday's action. Gap down, of course, trade news and information that kind of led to this getting killed here over the weekend a little bit. And then a nice steady trend down here into the beginning of the week. So that brings us to our most recent action. So let's take a look at some of the stuff going on within this trading range, within this channel here, that happens with momentum. So momentum, fractal in nature, like your impulse waves, and you'll have shifts within a bigger move like here. This is labeled E on the smaller chart. And you'll see a stronger move up to start with, and then it shifts. You got a slower move. So I'm transecting these channels. I'm basically putting a line right through the middle of each of those smaller impulse waves, those smaller moves here, like 1 and 2. And remember from earlier, I said, hey, if you got more of a price correction the first time around, time correction the second time around, you're going to be more likely to get a stronger continuation, a stronger breakdown out of it. Really simple core concept here that a lot of people seem to miss sometimes. They'll think, oh, I'm just focusing on a two-wave correction to the upside, and then that's going to always be a great short. That's not the case. If you have momentum that shifts, you've got a higher probability that it's going to give you a really strong start to that breakdown instead of just kind of thinking about getting started. One of the trickier patterns, since we've got some more advanced folks here, is that you will get a move that will start. This is a pretty average, stronger than average move here on D. But a lot of times, if you started over here and you had a higher high over here, you would have a pullback here, correction, pull back here. So you might have two decent impulse waves here and here, but the overall channel has slower momentum like this. And then you'll get a further shift in momentum like this, and that usually leads to a much stronger breakdown. That's what we saw happening in the overall market over the last 2 weeks. It started off slowly at the highs and then basically built steam. And a lot of people are caught off guard by that because they think, oh, it's starting with a slow gradual correction. That means it's going to break higher. And then they're shocked when it actually ends up breaking lower because the momentum within this range and the wave count starts to shift it so that it breaks down instead. So usually if your pullback is, let's say your pullback is 10 days and then you go into a 10-day zone of congestion where it's bouncing back and forth, that's one key point that breakdown can happen. And sometimes if it doesn't get going there, it'll go out to 20 days and then break at that point. But it'll start off with the slower pullback, your base, and then just kind of drops like that. So you'll have a really rapid move on the breakdown. That's one of my favorite ways of looking at trend moves. We better dig into some of these trades here. So let's see here. Slower than average move leads to a nice breakdown. So here's one of the very first trades of the week, and this is on the NASDAQ. So we actually have the micro E-minis here trading now this week, and of course I had to try them out. They've been pretty fun to trade. I get a lot of traders that come in and they have smaller accounts. So you go from sim trading to all of a sudden you're risking hundreds of dollars on a trade. It can be pretty problematic for some folks. So the micros are offering a great middle ground, and I wanted to see how well they trade. So I took this buy here on the MNQ. But why did I buy it here? We had zones where you've got, measured impulse move here compared to here. You've got shifting momentum here already. You've even got your 3-wave count, or 5-wave count if you want to call it Elliott wave. Drop, up, drop, up, drop. So why didn't I think it was going to turn around totally here? This is what catches a lot of people. This is what traps a lot of people. So let's go into the details here. So here's your typical Elliott wave little move here at the lows. But notice the momentum. You've got a bit of a stronger bounce and then a slower bounce. Pulls back, drops pretty quickly, but that makes it harder to turn around because the momentum's not really shifting yet. It'd be better if from 3 to 4, you actually had more of a V type of bottom. That would usually help turn things around a little bit better later on. So this pattern is actually what I call a momentum reversal plus. You've got your, again, time price correction, then more of a time correction. And then as we go forward, a little bit of this momentum shift off the lows. So it does give you a bit of a bounce if you're a day trader. It's the scalpish type of move. But then momentum starts to shift again here at 4. You get this slower move, slightly higher highs, changes the entire trend, and breaks down again with the impulse waves. Usually this breakdown for the continuation, this particular pattern, you'll get 3 lows that are lower, and then you will get the bounce, breaks the trend channel, and then you'll get 2-wave move to a lower low. And you've got a nice little momentum shift in here. So this is the trigger that I had for the buy, and I actually missed this exact trigger here. So when I alerted it, it was trading up here, waited for the congestion, built into position within the congestion here. Again, with the momentum shift. So here's the momentum reversal. This is a template. I'll show you this here on the next slide as well. And what we're looking at is this overall move. So you've got your 3 lows, 1, 2, 3. That was supposed to be silent. And then we've got the bounce and the 2-wave continuation here on the downside. So this gives us the momentum shift here. This little slight change. So this could be called an ABC as well. Leads to a nice turnaround and a good reversal on the market. So here's the momentum reversal template. Let me show you guys a little bit more of the details here. Basically just flip that template over. And this whole template here repeats again and again and again and again in the market. So it's not just something that happened this week. It's something happens pretty much every week. And here's our break higher, first level of resistance. So what happens next? Now we've got a momentum move where the momentum on the upside is pretty average. Nice, decent, steady move. Comes into a zone of congestion. So I'm thinking, okay, I'm looking for a buying opportunity now. Let's look at the details though. Here's what it looked like when I posted, hey, let's watch for this Phoenix. That's basically a Phoenix, I just call it the first zone of congestion when you're coming off of a low. So it's Phoenix rising, right? Makes sense? Okay. Avalanche, I just call it the reverse. Again, didn't have anybody teach me technical analysis, so I'm like, hey, what do I call these things? And so Phoenix is basically your handle in your cup with handle. It's your right shoulder in an inverse head and shoulders. It's that first zone of congestion coming off of the lows. So here's the template I drew them. I'm like, okay, we're coming up here. I want to look for a second pullback here, and then it's going to be the buy. So here's how it ended up playing out. You had your two-way move up, and you can see I don't sleep a lot, and the lovely little correction with the change in momentum here. So great thing with technical analysis is that things repeat over and over. This move, though, notice the 1, 2, 3 highs, two-way correction, two-way back to highs. That's that momentum reversal plus pattern, that template that I just drew for you. But it only leads to a little pullback, a little correction here. That's great if it's a daily time frame, you've got a couple of days movement. But because of the placement and the larger trend, how it was rounding off at the lows on the larger trend, it's not something that would lead to a full-on trend reversal. So trend placement is really important. So this gave a short here, wasn't paying attention to that one. But you can see I was there, but I was half asleep. But it pulled back here and then gave me the buy a couple hours later here. Nice little breakout higher, but the momentum is slower. So if I'm looking for a measured impulse move, my target level's up here, but the momentum is slower. So that means I need to think of a closer target. Usually about 3/4 of what your previous impulse move is a good zone that you'll see for a target. So you can eyeball it. You can use Fibonacci extensions, 76.4% extension. It's going to give you right in that same ballpark zone. I get to chatting you guys, and I just keep going. So here is the larger pattern. Here's kind of the rounded low here. And then this led into a larger Phoenix, but this time it's tilted. So here you've got the slower pullback, more of a price pullback, but this began to gain momentum. So here was my projection on where this was going to go, and here's how it played out. So here was that initial impulse move. You can see it marked A over here on the template that I drew for folks. A little bit of congestion, offered up the continuation, stalled right around that 76.4%, shifted momentum, made it the 100%, then shifted momentum again. Smaller two-way move. This is actually a core short pattern right there. And if you're thinking in terms of Elliott wave, you got 1, 2, 3, 4, 5. And again, I'm thinking 2 main impulse moves, shift in momentum, and I want that shift in momentum to generally have 2 moves. That's going to lead to one of the stronger reversals. So this is actually the exact same pattern that happened at the end of last summer in the overall market. So that's what helped me time the market that turned around at the end of the, basically, 2/3 of the way through last year. We had the exact same pattern happening here. So here is that whole move played out. And what you'll notice is that we're not only able to use all of these things in determining where that low is going to be, but also it helps with determining target levels as well. So you might be in a trade wondering, hey, can I get a little bit more out of this trade? Well, typically this Phoenix or this breakout will give you a measured impulse move. So this move off of the lows, the initial buy, you'll get that measured impulse move as a target level. As you saw earlier though, if the momentum is slower, it'll have a harder time giving you that 100% target. So it hit 76.4%. But when it went in, did a second pullback, and did the larger pattern, the momentum was actually picking up. It was a lot stronger. So you can look for the 2 smaller impulse waves as a new target level. And that's where that template was that I drew when it was initially starting to form the continuation right there. So I was looking at that two-wave continuation. And then things start to shift at that point, and the market has a number of waves of correcting. Again, this is how things started with the NASDAQ this morning. They had a little bit of a correction, a little bit slower, but then they popped up because this was a slower move here. So this shows you the trend exhaustion, and if you enter new trades at that point, you're going to have a much harder time, a lot higher risk. So I want to share with you guys, I've been teaching almost as long as I've been trading. That, I think, is what contributed to my longevity in the market, because I started out as a swing trader in stocks. And I began by creating my own website, swingtrader.net, and I posted my research there. Posted what I was looking at, why I wanted to buy it, why I thought it was going to work, why I thought, hey, here's the cons, here's the pros. And it started to get a following. So one of the educational firms was like, hey, would you like to teach some of our traders too some of this stuff? And what happens is that when you teach people something, you're going to find out really soon if what you are teaching them is bogus and if it doesn't work in certain cases and it only works in other cases. And then you've got to figure out, okay, so why did it work in this case? Basically going back to what my original conundrum with typical bull flags and bear flags was to begin with. Why does something work in certain circumstances, not work in other circumstances? Why is it that that momentum reversal pattern that we saw on the last slide here, well, not last slide, but right here, where'd it go? I'll show it. There we go. Why is it right here where you've got the three highs, 1, 2, 3, two-wave correction, two-wave move up? Why is this a pattern that's not going to lead to a complete trend reversal? Whereas when we just saw that exact same pattern down here, it led to a much larger trend reversal. So it's trying to figure out the details of that, recognizing, hey, I'm not just looking for trend exhaustion in the near term. I'm also looking at where's the current pattern forming in a larger impulse move. So when you look at this zone of congestion that's taking place right in here, and you're comparing this upside move off of the lows to some of these larger impulse moves, well, this is really small. It's just like the current correction we've had in the market off of the highs on a daily time frame. It's just an initial move. It has a lot more potential to it. Whereas if it is down here and you're at a bigger zone of impulse move, impulse wave, averages, then it's more likely that you're going to get a better correction. So putting those things together is something that it takes me a lot of time. I've worked with a lot of traders individually, one-on-one, because everybody's a little bit different. They focus on different patterns, different techniques. So I learned over the years basically a lot of the details that if I was just trading on my own, not working with other traders, I wouldn't have picked up on them, and at least not picked up on them as quickly. So I've had a lot of people ask me to put together different courses over the years to help them progress their knowledge a little bit more quicker. And so I want to share with you guys an offer that I made to my traders over Mother's Day weekend. My mom was a teacher. That probably was part of what got me interested in doing the teaching end of things as well. I was one of those crazy kids that played school growing up, but we didn't have phones and stuff like that either. So I have my biggest course is Fibonacci Mastery. This is an 8-week course, and it's kind of aimed more at newer to intermediate traders. It starts with the basics of my building blocks of technical analysis, building blocks of price development. So things like momentum, things like trend count, wave count, things like looking at volume, and how these all work together. So when I discuss strategies and patterns, things like that momentum reversal plus, that's a pretty intricate pattern there. We have a lot of patterns that make up the bigger pattern. Well, you learn all the details of each of those patterns, and you learn, hey, if this one takes place in this certain area, it's more likely to go on and continue in the next pattern. A lot of people think of patterns as like these snapshots in the market. Like here's a bull flag, here's a bear flag, here's a head and shoulders. but it's not, it's fluid. You're moving from one to the next. And how things like momentum and trend placement and the placement in these larger impulse moves, they affect the type of movement that you're going to get on the next trade. So Fibonacci mastery goes and it takes you from the very basics of understanding key Fibonacci tools with your trading and then putting it in the context of understanding how to read patterns themselves and how patterns develop. So think of it like learning a language. So it starts out with learning core syntax, some basic sight words and things like that. But then it develops into putting those words into an actual sentence. And how do those sentences form and how do they evolve? Now, next level up, probably where a lot of you guys are, is the Advanced Trade Management Bootcamp. This is something where I took traders that had already knew my system pretty well. And we got into looking at where different shifts and different placement changes the objective on a trade. So is this something I need to scalp? Is this a market I need to scalp today? Or is this a market, hey, I really need to be looking for a lot of swing trades to hold. I'm going to get a bigger move. Can I build into a position in the direction? Or is it something I just need to take that first move and be done? So my traders this morning, they're asking me, there was just a couple of them hanging out online, and they're like, so is this a reversal? And I'm like, no, it's just a scalp. But you can still get that two-wave little scalp. Just don't look for more, Try to get everything off as soon as you get that low level. And so that's what the Advanced Trade Management Bootcamp gets into. And then I also have 3 top Fibonacci strategies, which basically takes the Fibonacci Mastery course and ties in some of the advanced trade management and puts a different spin on things. And basically it's just complementary to that first course there. So these are all boot camps you can work through. They're on demand right now. You can go through them at your own pace. And any questions, you guys, you can pick that up at tonihansen.com/thanks, because I was thanking my mom there for encouraging my joy of helping you guys and other traders. But yes, go ahead.
If we take the macro view, could you just give us your view on what the SPX could do over the next week and over the next month?
Okay, so over the next week, I'm focusing more on staying in this zone of congestion that we're kind of having, but I am watching for reversal strategies to help bring us with the potential for another wave down. Because of that slide that I showed you guys with the overall market, that we're really in the upper level of what can be a larger impulse move. I think that looking for continuation patterns that can help go in that direction is a good way to go. In the bigger picture, so I always start the year with my way long-term outlook. Back in 2000, I did something that I think a lot of people don't think about. I went and I looked at the overall market using inflation-adjusted charts all the way back to the inception of the indices. And everything that I told you guys here today, everything I taught you guys, it applies to inflation-adjusted charts too. So we were seeing measured moves happening, measured impulse waves happening going back into 2000. And I'd only been trading for a couple of years. At that time, I didn't have the notion that, oh, the market always has to be a bull market. I'd seen a lot of the dot-com bubbles. I'd seen a lot of the sharp mountain types, Bitcoin moves. Bitcoin moves, that's younger, you guys understand that one. A lot of you understand the dot-com stuff, but a lot of you understand Bitcoin now. You had that same type of move up, and you'd see it crash. I'm like, wow, this is happening on the larger time frame in the NASDAQ too. This is gonna crash. I looked really smart, right? I didn't have that bias that the market had to go up. I only saw what was happening in the dot-com stuff on daily time frames and extrapolating it to larger time frame. Well, what do we got going on right now in the overall market? We've got a lot of those inflation-adjusted charts also hitting measured moves and 3-wave moves too. So let's start out slowly with the first one, second one, and then the third one, straight up. A lot of times the third one will have 1, 2, 3 continuation too. That's where we're at. We're up at that level on the monthly time frames and the inflation-adjusted time frames going way back. So it looks like we've had a really good correction over the last year, or really good choppy range. You put it into perspective, we've hardly corrected at all in the grand scheme of things. I mean, if you look at how the market usually corrects to that sort of an extreme move, it's not much. We can certainly go higher after this point, but probably not the same speed or the same momentum. It can still continue the trend, but like I said, a lot of trends after they exhaust, if it's a straight up trend, it doesn't always just turn around. It can chop higher. It can keep chopping higher. And so a lot of people, you know, back over the last couple of months, you know, as the market was crashing, they're like, there's no way we're going to see new highs again. I'm like, well, it can go up there. It can still go up there. And because we're still just in those early phases of the market correction. It's not a big level yet. So I think, you know, longer term, we're going to see a lot more of that volatility, the back and forth action. But yeah, so that's my bigger macro, if you want to go really macro. Yes?
Yeah, I'm very interested in your trading strategy. For example, I trade the ES and YM.
Uh-huh.
How wide are your stops on the NASDAQ and other things? Because, you know, they move rather rapidly, and a lot of young traders get out there and they get their butts handed to them.
Right, because they're using those channel breaks, right?
Yeah. So anyway, how wide do you keep your stops?
Really crazy tight. But I use a system of building into positions a lot of times where I'm buying at, like if you get like the ABC type of correction, the two-way pullback, I'm buying at support on that second wave before the chart is ever broken out. So I'm building into, like showed you over here, I actually mentioned this to the other day. I hadn't had a single stop that I'd taken, or stock or security or anything, that I'd taken a stop on so far this month. And they're like, that's not possible. You can't do that. But you can, because on a move like this, I'm building into positions as they're pulling back in here. And there's usually something here with, so one of those additional building blocks of price development is time development. So certain periods, certain times, something is more likely to break out than other times. So that's one of the things that I'm looking for. That's one of the things that's in the courses that I do. So I'm buying as it's coming right off that support level. So a lot of times my stop is crazy tight. But what I do is an initial move, I protect part of the position and I look to add into the position. So I'm building into the position using advanced trade management. I'm not going all in and then all out. I'm scaling in at those newer levels. So for example, buying on here, taking off a little bit here, adding back in here. By the time it breaks out, a lot of times I might be at a position where it's basically flat if it goes and breaks under this low again. I'd be able to do more of a scratch type of trade. So
When you say tight, what do you mean? How many ticks out?
what's that?
When you say your stops are tight, how many ticks out?
It depends on the time frame, because I'll do scalping and then I'll do, so like a scalp, it might only be like 10 to 15 points on the NASDAQ, on the NQ. But if it's a larger time frame, it might be a little bit larger. But if I'm using the scalp entry to get into a larger time frame setup, then it's still going to be really tight.
So you're actually looking at a 40 tick, or you said 10 points, 40 tick stop that's out, is what you're saying, right?
A lot of times it's not even that big. I mean, it's just, if I'm just like the scalp I showed people here today, I think it was like 5 ticks is like what would have told them that, hey, this is wrong. But they were only looking for a 10 tick move or so, or 10, maybe it's 15 ticks. And I'm like, you have to scale it based upon the time frame that you're looking at. So basically, like this channel pullback here, I'm looking to get in right as that pull is happening. So here's a trick. Those of you that use like Fibonacci fans, if you're looking at an upside move here coming off of the lows, if you line up the first low with a 61.8% fan, you can buy at the 76.4% fan pretty well, and it's going to hold good over time. So I'll actually be buying as it's hitting that support zone. Volume will also usually be really, really light. So it's scary for a lot of people to buy at that point because there's like the lightest volume it's been. Yeah, go ahead. I think I'm about out of time here. Yeah.
Okay, that first buy you did up there, did you buy because of that gap, or did you buy because of break of the previous one before that big down day? It's because there's not enough there to say there was a trend change.
Right, so at that low, we were at,
It was just you felt that was the bottom, or?
so we
I
were
don't
at
see
that,
what were your key-
that low here, right here, this is about that low of that purple line on the daily time frame where it was a large, an impulse move. It was an average impulse move at that zone. And then we had that 5-wave trend exhaustion here, then the shift, and then it goes 1, 2, 3, and shifted momentum there. This is a trap pattern. Again, I call it a momentum reversal plus. It's a trap pattern, but it's because I know that pattern over and over again, where it's one pattern that goes into another and it repeats over and over again. That's what builds the confidence into that. So the fact that it was at a major support level on the daily time frame, it had already had measured impulse waves on the downside on the daily time frame. So it put it at a good level for that pattern to develop. So that kind of goes into a lot of more advanced stuff, but I'm happy to talk with you out here, or you can send me an email and I'll chat on the phone and show you some more of the details too. Yeah, go ahead.
When you tranche in, like 5 different tranches? Is that what you're saying when you kind of
build into position?
Yeah.
It depends. A lot of times I'll go all in at once, but then I'll offer out at really close levels where I'll have maybe 1-to-1 or 2-to-1 return compared to what my risk is, and then I'm building back in at a little bit of a lower price point. So like, let's say, for those of you that are newer trading the micros, maybe you go in with 5 contracts. So I'll take 1 contract off, add it back in, slightly lower, take it off again, add it back in. And that puts me at a point where by the time it either goes or fails, if it fails, I'm more likely to take a scratch. So my worst trade over the last week, it still covered commissions, but it failed. If you had taken a traditional channel breakout and a traditional stop, I would have been totally stopped out. Would have completely lost the entire amount on that because it just couldn't play out. So that's how a lot of traders that have been around and trading for many years, I know a lot of you guys trade like that as well. So I've got to get going. They're saying, hey, get out of here. But I'll be out here if you have any other questions, and you can also look me up. Like I said, go to tonihansen.com/thanks to grab that offer, and tonihansen.com/Vegas to grab the PowerPoint. Thank you, everyone.